And to our final speaker for today, we're turning to Lenny Murphy.
Hi, Ray, and
Hi
hi,
there.
everybody. And big shout out to Scott and Holly, because you just made my job a whole lot easier. Again, we did not coordinate in advance, but boy, you helped tell the foundational story for me. I agree with everything that Scott and Holly have just said, and my approach today is actually going to prove that by looking at some of the big picture kind of lumiscape of the industry, and particularly where the money has been flowing from an investment standpoint. And I think that it will absolutely reinforce the points that were just made. So, first, I think it's really important that we always recognize that the research industry exists to serve the marketing industry. And to help put that in context, we look at kind of all of the different components that the marketing organizations are responsible for. Control, analysis, planning, implementation, different tactical elements like promotion and price and product and place. And here in this inner circle, this is really where research starts to get in from a strategic and tactical element, where we're focusing on these big buckets of segmentation, targeting, differentiation, positioning. All of that creates customer value and relationship, the type of stuff that Scott was talking about. So the role of research is to inform this entire process, and increasingly there's lots of other data sources that help to do that as well. And while that's happening, the speed of business from a marketing standpoint is certainly changing the dynamics in our industry. We see that as kind of three competing priorities. First, service consulting is not going away. Buyers aren't staffed to do all involved to generate actionable insights. They still often need help. So although we absolutely agree that automation is coming into as a major play within the category and will transform it overall because of the second priority of speed and cost, it doesn't mean that the role of the researcher itself, to Holly's point around not being able to duplicate creativity and human ingenuity within a computer system, we're still seeing AI and automation changing the game in terms of speed and cost. And as Scott had pointed out, data synthesis and analytics continues to be a major trend as well. So the traditional role of research of being consulting driven and very focused on one specific business issue, that is changing dramatically. We're being asked to step up to do more from a data input standpoint, to do it cheaper and faster, and still deliver consultative recommendations when needed. But if we look at how that's kind of playing out, the ecosystem has changed. So the companies that we would define as research companies, who look to the far right, kind of this basic category, self-service, automated, tech platforms, outsourced, this is where the research industry traditionally kind of existed. But today, those data sources have changed a lot. So we have, shout out to Simon Chadwick for actually creating this originally. We have the structured big data. Those are the companies like IBM and Oracle, but certainly Nielsen is playing in that category, dunnhumby, Axiom, lots of big companies that play here that are taking information from lots of sources and utilizing that to generate insights or let their clients generate insights. We have reported consumer. This is a piece of traditional research, companies like LRW, YouGov, Merits, basically any company that is asking a question, but often those questions are informing different types of business issues than just marketing. And then over the last few years, we've seen the emergence of the unstructured big data, which are all of the companies that are ingesting information through a variety of sources that don't have much to do with asking a question, but instead are either kind of taking the digital exhaust of consumers and or different other components of data that are flowing into organizations through usage and CX, et cetera, et cetera. So the lumiscape has changed quite a bit. Research used to be the primary source to address these questions, and today there's lots and lots of other companies that are doing that. And if we go to the next one, if we look at data generation, this is a little more of where research fits, but even that is now highly fragmented. So we have the syndicated transactional data, we have proprietary data that's being collected through a variety of platforms. Of course, we have the emergence of all the DIY solutions, and there's a ton of those. There's qualitative and all of its various and sundry components, including mystery shopping, ethnography, kind of proprietary qualitative approaches that exist. Increasingly, we're getting latent and response. Latent is social listening, geolocation, usage and telemetry data. Lots of companies that play there. Very few of these are traditional research companies. And response, which includes biometrics and neuroscience, eye tracking, emotional, and again, a lot of familiar names to research, but a lot of unfamiliar names to research in here as well, including some very large technology companies that are playing in this world. So the landscape of research has changed, and what all of these companies really have in common is scale. Almost all of the companies here, without exception, have investments in technology and investments in overall business models that are built to scale, that are not based on ad hoc one-off research, but instead are based on a very different model. And that's important. So how do we see that shaping up in terms of client investment? So we asked a question in the last GRIT study around investment priorities. And this was very telling of where are the investment dollars on clients going to. Visualization and dashboards, obviously a very large one. Analytics, data collection is still in there. New types of data. This is where investment dollars are flowing today. So this tells us a lot of what are the priorities in terms of the ability to answer business questions. And we asked a follow-up question on that as well, but I thought it was the next slide. It'll be the one after this. So we'll get to that in a second. But this kind of backs up some of that as well. This is from SMR data and looks at the breakdown of spend by methods. And of course, quantitative data, data that's easy to come by because it's either structured or can be structured via technology, is still the primary spend point, with everything else really, in single digits in terms of the level of spend. Of course, automated is the next largest one, and I think that's a surprise for a lot of folks. That's just beginning to emerge. So we're seeing this not just from GRIT, but we're seeing it from SMR as well. And here's the slide I thought was next. We asked a follow-up question of why are people investing in these solutions? And what really rose to the top, obviously, is a clear linkage to business objectives and delivering recommendations to drive the business. And ultimately, that's what we have to keep in mind, is that as clients are making their budget decisions and investors, which we're going to get to in just a second, are making their decisions, it's about delivering business impact. And that business impact increasingly in the world of KPIs and a very complex and fragmented ecosystem of different solutions don't always have to do with individual consultative solutions. Often they are driven by speed, cost, and the ability to deliver information when the business question needs to be answered. So these are kind of the big macro forces if we pay attention to what's happening in the industry. We see this in GRIT as well. Ray could probably speak to this better than I can, but we've been tracking for years the adoption of what we think of as emerging methods and online communities. Continue to be at the top of the list. Text analytics, mobile first surveys, social media analytics, big data analytics. These things are all inherently scalable technology-based solutions, and that's where the growth is happening from an adoption perspective. Now, if we look at this, I don't have the slide for it for SMR, but if you look at the GMR report, market research is $71.5 billion. When you split that and look at the percentage of traditional MR versus new MR, and a lot of the things that we're looking at here on the top of this list would be considered the new MR solutions. Traditional market research is relatively flat. All of the growth that is driving the industry is coming from these types of solutions. It's coming from scale, technology, data inclusive solutions that are delivering more information generally at better costs. So now, what does that mean when we look at it from a business standpoint? And Scott really touched on this, and it's what we're going to talk about for the next few minutes. Historically, capital flows into the research industry have paled in comparison to the analytics industry. So when you compare those two, there just hasn't been an awful lot. There's been some peaks, obviously, here and there. And this is only through 2016. I think in 2017 we would see this start to peak some more. But when we look at from an investor's perspective, the money has flowed into analytics solutions. And I think what those analytics solutions tend to have in common is, again, they are technology-based, they are scalable, and they are data agnostic to an extent. Certainly not all of them, but many of them are working towards the ability to take information from lots of different sources, including research-related kind of structured data sources, and deliver that in a very different way. Now, we've seen some exceptions start to happen with this. If we, right before the webinar, I just did a quick check, and if you look at some of the usual suspect companies that have received venture capital over the last few years, it's pretty significant. You know, GutCheck, automation platform, 22 million. Lucid, automation platform in sample and data, 64 million. Qualtrics, of course, you know, the big gorilla, 400 million. You know, Vision Critical, 41 million. ZappyStore, 12 million. VoxPopMe, 3 million. Remesh, 12 million. MarketLogic, 46 million. The list goes on and on. Those companies all have one thing in common. They are technology platforms that are built in some form or fashion around automating the process to ingest information and then create tools for people to quickly get answers to the questions that they need and put that back out. That's where the money is flowing from a venture perspective. And that's important for us to recognize as we're looking at building the next generation of research companies. Investors are not investing in consultative solutions. You know, they're investing in things that provide scale. When we look at the capital structure, again, not many IPOs exist in the research space. You know, we saw some peaks around a lot of debt financing, which occurs with private equity, and that continues to be a good source of revenue for companies that reach a certain level of size, but still not a ton of activity around A, B, and C rounds, and certainly nothing that has become public. Now, I think that we're going to see some changes in that. We saw Macromill go public, YouGov went public, BrainJuicer is public. I would certainly expect to see Qualtrics go public at some point soon. So this may change up the model as we look at 2017. But historically, there hasn't been a lot of big out of the gate massive success stories in the world of IPOs. What we have seen are some large private equity transactions. So we've seen Maru Matchbox with Primary Capital Partners, of course KKR with GFK, HGGC with SSI, Core Squared with Research Now, and of course we saw the recent merger of those two, Tailwind Capital with LRW. The list goes on and on. So private equity continues to look at companies that have reached a certain plateau of scale and size to help develop them into the next platform place. And these are the companies that increasingly will probably become one of the major exit channels for the technology companies that are starting to emerge and grow. So as we look at, you know, what does the future look like? Would we expect to see a GFK, for instance, acquire a Lucid or a Zappy? Sure, absolutely. One day that could happen. It's not going to happen now, but those are the types of solutions where we see the industry change. What I think will be really interesting is how the existing big players, the Ipsos and Nielsen and Kantars of the world, handle this changing marketplace. They're not actually positioned incredibly well to be able to navigate this. They're under a lot of competitive pressure, and they don't necessarily have the same level of pockets to be able to do some of these transactional transformations that are occurring. So it's going to be something to really pay attention to for the next generation of entrepreneurs as they're looking for exits to see where that happens as they're raising funds. If we look at how market research compares to some other companies that are, I would consider adjacent to us, from a publicly traded companies, our revenue CAGR certainly is not nearly at the level of large cap tech companies or even marketing technology companies. Consulting, media, advertising agencies, those are comparable, but where the real money is being made are certainly in these other categories. These are the points that we need to compare from a metrics perspective. Valuation multiples, again, research and analytics way down here at the bottom in terms of the valuation by revenue. Marketing technology, for instance, massive, far, far larger in terms of what those valuation multiples look like. This is, again, important as we're looking at the next generation of entrepreneurs that are developing companies. They see this data, and by design, their companies are trying to look a whole lot more like a marketing tech company than a traditional research company, because it's the smart thing to do. It's where the growth is coming from the industry. It's where clients are spending their money, and it's where the path towards creating real value for shareholders and for founders comes from. M&A activity, again, we look at the number of deals, not much happening within research compared to some of the other categories. Now, the ad agencies are a bit of an outlier here because they're always gobbling up each other, but where deals tend to be happening more and more around e-commerce, online digital media, traditional media, marketing technology, at a much higher rate than we see just within research and analysis. And if we just look at the overall multiples, again, from a valuation standpoint, this is from a revenue perspective. Research and analytics carries, the way it's been traditionally defined, has a much smaller multiple than we look at even a consulting company or ad agencies, traditional media, and of course, digital advertising, online digital media, and marketing tech carry far larger multiples on average when looked at from a revenue perspective. And when we look at EBITDA, again, research does okay on average, about 11.6, but again, nothing compared to marketing tech. And increasingly in the world of programmatic and automation and a sample, companies are looking a whole lot more like marketing technology companies. And we see some of the larger sample providers that are all launching programmatic advertising solutions and targeted media solutions. Research Now SSI is doing that. YouGov is doing that, even Lucid, Cint, et cetera, that's them trying to move into this arena of taking technology, leveraging that in a new way, and looking like a marketing technology company so that they increase shareholder value due to valuations as they head into exits. And financing, same story, right? The research is far below some of these other things. Marketing tech is getting tons and tons of financing activity in terms of venture funds. So what does all this mean for the research industry? VC capital infusions are maturing and declining overall, which means that we're seeing more A, B, C rounds start to occur, but venture is still being pretty selective on only playing in arenas that look a whole lot more like marketing and technology versus traditional research. The flip side is that private equity interest in the mature side of the industry continues to grow. So, we are seeing companies that are, in that $20 to $100 million range in general, getting a lot of private equity groups expressing interest. I know that's a big part of my business increasingly, is working in private equity groups and looking at the categories. So we'll see some more consolidation of kind of mid to somewhat large companies beginning to take advantage of that and forming new platforms. There's a big gap for capital for middle market companies. It's really hard for a company under the 20 million range to find outside capital to grow. Those are solutions that I hope that we'll see change over the next few years, but the capital markets generally tend to ignore those. So there's a lot of pretty cool companies that are not necessarily technology led, but are technology driven, that are really stuck trying to find a path to help accelerate their growth. There's a lot of new tech startups that are they're tapping into the VC markets because they don't talk about themselves as being research companies. They talk about themselves as looking radically different. So what's the next growth driver? I think that Holly and Scott both hit on it. It's around platforms, and it's around automation, and it's around those companies that can drive that and deliver that type of positioning. That's where the money's going to go. Now, the business model applications for research companies are interesting here as well. I think that the big research companies will continue to acquire innovation. They'll consolidate. So, how did Kantar and Ipsos, for instance, get so big? Because they bought a lot of companies to get big. And I think they'll continue to do that, although it's going to be more challenging with technology companies because of their valuations. The big analytics companies will certainly continue to grow. Those companies that can offer a non-siloed data agnostic model to ingest information from lots of sources and or house it or become the core platform where it's accessed. Those will continue to grow one way or the other. The smaller to medium analytics companies that are trying to focus on niche categories, it's still going to be a problem. They're going to continue to do well organically based on relationships, but they're going to be under increasing pressure from these larger platforms that are emerging that can do a whole lot more. Automation, it's going to continue to grow and grow and grow. It will disrupt a lot of the existing business model. A lot of companies should begin some exit planning if they don't think that they can really effectively deal with that. All of these new categories that we call NewMR are gaining niche acceptance. We saw some additional analysis in Grit, for instance, around even the neuromarketing tools, that when you net those all together, they're starting to emerge as pretty significant players, even though separately they look smaller. And I think we'll look at a lot of small to medium MR companies merging or partnering simply because they have no choice. They need to find a way to achieve some growth outside of just organic competition, and one of the easiest ways to do that will be some like-for-like stock transactions that are not necessarily dependent upon outside capital. We'll see more roll-ups starting to occur as companies look for an opportunity to leverage the assets they have in a way that can be done independent of external capital. So, ultimately, when you follow the money in the research industry, what it points to is that traditional research players are going to continue to struggle for growth unless they are building technology-based solutions that deliver that scale, speed, and cost efficiencies that we're seeing grow more and more and receive more and more external funding. And I think that validates what Holly and Scott were saying, and I'll take questions now.
Thank you, Lenny. Excellent and informative as always. I've got a couple of questions coming through, but there's a kind of quirky one that's out there in Twitter. Where do you expect to see yourself, Lenny, in 5 or 10 years' time?
Hell, I don't know. That's an interesting question. Retired, hopefully. I can tell you that it's been interesting to leverage this unique role that I've developed to play more and more in equity markets. I consider myself increasingly more of an investor and a deal maker, and I expect that will continue. So I don't think all the other things that I do will continue to play, but the end result of that will probably be driven a whole lot more around M&A and investment activities than more of the traditional consulting and advisory work that I do today.
Which actually brings on to an interesting question for a lot of people listening. So some of the people listening at the moment are probably entrepreneurs, wannabe entrepreneurs, and the majority will be employees who like working in this research industry. So we can see that the best multiples are in marketing tech companies, and that's why we see companies like Confirm It and Vision Critical very clearly in that space. But where are the places where you'd have the most fun? And Jeffrey Henning has run a study on this in terms of satisfaction, and maybe we've got scope here for a future Grit study. Where do you think the best salaries are in the research industry? Are they in the marketing tech companies, or do you think they might be in the artisanal companies?
I don't know if I have data to back that up, Ray, but my gut would be, and as I process information that I've seen, there is always an immense need for smart people that can help deliver business impact and insight, and those people are worth their weight in gold. Now, as I continue to lose weight, I may be hurting myself from that standpoint, but but I think anybody who is smart that can connect information to business outcomes and give guidance they are always going to do very well. Conversely, folks that can manage the technical aspects of both the development of tools and or analytics are also incredibly in demand. So both of those sides, let's call it the consulting and the tech sides, I think are equally in demand. Methodologists, yeah, that may be tougher, but it certainly can be fulfilling. The traditional roles we have in research that are very functionally focused, probably not where I would spend my time from a career building standpoint.
What about roles like David McCandless with his Data Series Beautiful? Do you think that our industry could sustain some real gurus of interpretation, presenting, video editing? Because obviously there's good employment in that zone, but I wonder if there's some premium employment in that zone too.
So I think anybody could position themselves as the thought leader around a specific topic or function and can prove that with backing that up by how it benefits the business. Obviously, they can do very well. Mark Earls comes to mind, right?
Yes.
I expect that Mark earns a very good living, and rightfully so. I think that there's a lot of folks that just are really super smart in some very specific areas of expertise, and they will always be in demand and will be able to make a healthy living. The problem is I don't know how many areas there are to specialize in to create that niche for yourself, right? So that's a fairly small map of opportunities overall. So we'll see. But to your point, I think that there's certainly opportunities for people to be able to specialize and become the real leaders across the board and do well in their area of expertise.
Twice a year you run this fantastic competition through the innovation competition. What are the common threads that play through the people who are winning those competitions? Are they more likely to come from some countries? Are they more likely to have certain approaches or styles?
So I haven't analyzed specifically, although I think there's probably more U.S. companies than not, but there's certainly a good group coming out of Europe. The winners almost all in the last few years have been focused around technology platforms, scalable solutions. Some have been very niche, addressing specific business issues. Some have been very broad-based. The most recent winner, Pix&I, out of IIeX Europe, very cool stuff around utilizing video and images, and I think that's certainly an emerging place. Companies like Live and Lens, VoxPopMe, now Pix&I, others. That's the next great opportunity for companies to gain early competitive advantage by leveraging that type of unstructured data. The companies that have not done so well are the ones that are more consulting focused, even though they've had some really great solutions that they've developed, some proprietary IP that is just really interesting for addressing some business issues from a consulting standpoint. They just tend not to be able to break through. And I think that's also indicative of, if we look at the judging panel at the events, by design, we focus on clients and investors in being the judging panel. And they're looking at those type of opportunities of which companies are going to grow, which companies are going to scale and deliver real value. And as we just saw in the presentation, it just tends to be those companies that can deliver on that promise.
And thinking about some of them, I would say that they're probably what they would self-describe as serial entrepreneurs, and old-fashioned people would say they're people who've not really been successful once or twice previously. But I think that is often a pattern in winning, is to have that experience of trying it, not necessarily succeeding, trying it. I'm not even necessarily failing. I'm thinking now, for example, Zappy Store. Stephen Phillips had done some of the things they'd been fine, they'd been successful, but that gives you more of an oomph to go forward, I think.
I agree wholeheartedly. So I, so I have owned 10 companies in my life, and each one got a little more successful. And because I didn't know what I didn't know in growing those first companies. I just knew I was a bad employee, so in order to make a living, I needed to work for myself. But I didn't know much about running a business until I learned how to run a business, right? Until I had breakthrough ideas. So I think fail fast, move on, and each failure just helps us grow as entrepreneurs. I would encourage anybody to, just because the first business didn't do as well as you would have liked doesn't mean the next one's not going to. So, keep plugging. Absolutely.
Yeah, I'd never really thought about it before, but I'm probably on my 6th or 7th business, which I either own or part own. So, yeah, there could be something in that. So, final question, Lenny. We've got one here. You said that the MR needs a scale of $20 million or more to get capital. At what level do you see that on the tech side?
Yeah, well, so I want to be clear, it's more around private equity capital.
Right.
So not necessarily all capital. And it can be a little bit lower. There's just not as many companies that participate. But I'm not sure that there is necessarily a difference there. There's economies of scale that happen from a private equity perspective, and that's based primarily around EBITDA and multiples and just the pain in the butt factor to go through an investment, and it is a pain in the butt. So you start to see those economies of scale happen really around the 15 million level plus, and the bigger you are, the more attractive they become from an investor standpoint. And I don't know if that's different between based on the business focus, whether it's tech or service based. I think it's about the same based on my experience. Now that said, there are certainly more opportunities for venture capital for technology companies smaller than that. So, and that's just, you just got to find the right investors. Increasingly what's interesting to me is that we're seeing more research companies emerging as seed investors in early stage companies. And then eventually as acquirers. I think we just saw it actually, Big Sofa. Ipsos was one of their earlier stage investors, and Ipsos just bought them. Kantar famously was one of the earlier stage investors in Zappy.
Yep.
And so that's a really great function for larger companies to help find those to help invest limited amounts of capital and then help those companies scale and grow. Eventually, they may acquire them. Eventually, they may just make their money back from an investment standpoint. So I'm really excited to see that begin to happen more and more, where larger companies are doing that. Even companies like Schlesinger, for instance. Schlesinger is a $100 million company. They were one of the early investors in Remesh. So that's exciting to see that we're starting to have a kind of a homegrown early stage, seed, angel, A-round community emerge within the research space with smaller scale tech companies to help them achieve some level of growth pretty quickly. And clients do it too, which we should also mention. So, P&G, Unilever, Coke, Microsoft, they have all invested at various times in early stage companies as well.
Yeah, absolutely. There was great example of that at the SML conference where Coke wanted Zappy Store to do work in Japan. There was no budget for it. There were lots of costs. So they simply bought projects in advance and said, okay, we'll buy this many projects. Now can you go ahead? And what's more, they helped them to set that up and running. We see Unilever and Brain Juicer, a similar sort of thing, and they more than made their money back out of that.
Absolutely. With the vehicle they usually use are debt equity notes in doing that, which is a really nice way for them to for brands to help early stage companies without necessarily writing them a big investment check, right?
Absolutely.
So,
right, Lenny, we better call it a day. Thank you so much for sharing your wisdom and your knowledge.